The Reserve Bank of Australia cuts hawkishly, warning of uncertainties around the labour market. The question now is, will it cut again this year? And Australian consumers lost a bit of confidence ahead of that rate cut. That's coming up in our 5 Things in 5 Minutes on Wednesday, February the 19th. And then in today's bonus deep dive interview, ANZ New Zealand chief economist Sharon Zollner analyses the choices faced later today by the Reserve Bank of New Zealand as it decides how much to cut interest rates.
We don't see anything in the data that would really change the narrative or force them to reassess their strategy, which has been to cut quickly initially and then be a little more cautious as they get close to neutral.
But first in 5 and 5 with ANZ. Global markets are mixed this morning, digesting the latest tariffs toing and froing and uncertainties over Ukraine. The focus in Australia and New Zealand this week, though, are the two central banks. The first of which, the Reserve Bank of Australia, yesterday cut its cash rate target by 25 basis points to 4.1%. Its first cut since November 2020. It had been at 4.35% since November 2023. For extensive coverage, here's ANZ senior economist Adelaide Timbrell, who says the main message in the announcement was its hawkishness.
Was a more hawkish than expected outcome today. So even though we did see a rate cut, the board's statement and Governor Michelle Bullock's press conference commentary was very weighted to not giving people the sense that another lot of rate cuts are coming through. In fact, there was some commentary around market pricing of a few more rate cuts over the next 12 to 18 months being too confident, and the Reserve Bank board being very cautious about the outlook.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was up 0.3%, in line with a 5 basis point rise in the US 10-year yield at 4.53%, as investors eye the bond issuance and inflation implications of tariffs and Europe borrowing more for defence. The New Zealand dollar starts the day at 57.00 US cents, down 0.7% from yesterday, in anticipation of a 50 basis point cut in the official cash rate in New Zealand later today. Number 2, the Aussie dollar rose slightly on the announcement. The Aussie dollar starts this morning at 63.48 US cents. The S&P ASX 200 fell through the day, including after the decision to close down 0.66%. Adelaide says the RBA emphasised that uncertainty on the strength of the labour market was leading it to be cautious about any next move.
So in the Reserve Bank statement, they said that there were upside risks to the labour market outlook. They noted that labour market tightness had not really eased lately. And in fact, in late 2024, the labour market had tightened further. They talk about the labour market being a key factor as to why they now think that the end of 2026 trimmed mean inflation forecast will be 2.7 instead of 2.5. So no longer at the midpoint of the Reserve Bank's band at the end of 2026, and that seems to be because of the labour market. And when they put out the judgments to their forecast and the risks to their forecast, the labour market appears again and again.
Number 3, Adelaide says the key thing to watch now is labour market data.
ANZ Research still forecasts that the next rate cut will occur in August, but the coming labour market outcomes as well as wage growth will be really important for the Reserve Bank as they continue to evolve their analysis of how the labour market is impacting inflation. On the one hand, they have acknowledged that the tighter labour market has not led to as much inflation risk as they thought, but on the other hand, they're also really looking at the labour market potentially as a signal of economic strength, because if the unemployment rate stays where it is at 4.0 or reaches the peak of 4.2, which is the ANZ research forecast and now also the Reserve Bank's upgraded forecast, which was previously at 4.5 and now at 4.2. If that is a signal that the economy is stronger than we think, then that's, for the Reserve Bank, is a risk that reinflation could occur. So for them, it's really the risks seem to be weighted one side. The commentary is very hawkish and the labour market is key to all of that.
Number 4. Another theme being watched for is how cautious the RBA will be about the volatile global economic environment.
Global trade uncertainty was mentioned by the Reserve Bank in their decision, but seemed to take a backseat to domestic factors this time around. They also didn't put a lot of the global trade uncertainty into their domestic forecast, but this seemed to be because of the quickly evolving landscape, meaning that the outcomes could really be in such a wide range that they didn't feel confident enough to impact their forecast either way.
Number 5. Ahead of the RBA's decision, ANZ Roy Morgan consumer confidence fell 1.6 points last week to 85.1, its lowest this year. ANZ economist Sophia Angala says, though, that confidence has been edging up recently after stage 3 tax cuts, and potentially now the RBA has cut.
On a 4-week moving average basis, consumer confidence has remained within the tight range of 86 and 87 points since the beginning of 2025, which is still above the average it held over the second half of 2024. We expect this upward momentum to continue in the consumer confidence series this year as rate cuts support households' disposable income. We'll be watching to see what this series does next week following the RBA's 25 basis point rate cut at its February meeting.
Sophia Angala there. Now, in our bonus deep dive interview, we turn to the Reserve Bank of New Zealand's decision today. ANZ New Zealand Chief Economist Sharon Zollner talks to my colleague Alex Tarrant about the picture facing the Reserve Bank of New Zealand, which is expected by ANZ Research to cut the OCR 50 basis points to 3.75% today.
The Reserve Bank took a bit of a risk in November. In order to ease monetary conditions over the summer, they provided unusually clear guidance on what they expected they would be doing next. That was brave because there was a 3-month gap between meetings instead of the usual 6 weeks. So all the data was coming out essentially. But as it happens, there's been some unders and overs, but overall I'd say it has landed consistent with their expectations. So GDP, for example, it was revised up in the past, but took a bit of a tank now in the middle of last year. So a bit of a loss of momentum there, but the overall level of activity not so different. CPI inflation, tradable inflation was a bit higher than they thought, but that key non-tradable domestic inflation was lower, so that probably comes out in the wash. Unemployment, bang on their forecasts. So overall, we'd say there's been nothing to really challenge the Reserve Bank's guidance that they will cut the official cash rate by 50 basis points.
I guess what everyone will be looking out for is the ongoing guidance. What do you expect they'll say? Will they be as clear in terms of the direction of travel, do you think, in terms of the next sort of 6-12 months?
The Reserve Bank always reserves the right to change their minds very wisely because we get surprised by data all the time. But their last set of forecasts showed the official cash rate gradually declining to 3%. The market was a little bit disappointed with the speed that was implied, but then took comfort from the comments in the press conference that gave such strong guidance that they would be cutting 50 points in February. When we look at the data that's come out since, maybe they'll lower that track a little bit, get to that 3% mark a bit earlier, but we don't see anything in the data that would really change the narrative or force them to reassess their strategy, which has been to cut quickly initially and then be a little more cautious as they get close to neutral. And they currently estimate neutral to be 3%, but with a very wide band around that. They're very good at acknowledging the uncertainty about exactly where the accelerator finishes and the brake starts. It's actually a bit unclear. So we are picking that they will slow cuts down to 25 basis point moves after that. Indeed, our current forecast is that they will deliver just one more cut to take the OCR to 3.5, but given the comfort they have about the inflation outlook and the fact that they think neutral is 3, the risks would seem to be tilted to more cuts than that. We'll wait and see what they have to say in their monetary policy statement and then take a look at our forecast at that point.
Is there a risk, given the currency moves in recent weeks, that tradable inflation continues to stay higher than anyone expected and that actually start taking a bit more notice of that than they have previously?
So essentially, inflation's fallen pretty much exactly like the Reserve Bank thought it was going to when they stopped cutting rates, but under the hood there's actually been a very different mix of inflation to what they expected. So the domestic inflation's been much stickier, but the import prices essentially fell much more quickly than they thought. We're now on the flip side of that, where the domestic inflation is much further along the trail to getting to where it needs to be. It's not quite there yet, but it's well on the way. But the tradable inflation is looking like it could have a little bit of a bounce, mostly because the New Zealand dollar has fallen. We've also seen a little bit of upside in oil prices as well. So would the Reserve Bank be concerned about that? Well, probably not if that domestic inflation is still behaving itself, if inflation expectations, if core inflation are all doing what they need to do. But if it was enough to actually see inflation bounce out the top of the band again, that would be a little bit awkward from a comms point of view. It is perhaps just one more reason to tread a little more cautiously as they approach neutral. But it really is that domestic inflation they care about. Tradable inflation tends to come and go, really wash through quite quickly.
Sharon Zollner there, speaking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, February the 19th. Catch you tomorrow with all the detail and analysis from the RBNZ's rate decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.